Good morning, everybody. Luckily, I've got a microphone because otherwise that room might not hear me. It's a big room. So thanks for filling it this morning. It's probably the last session between, the previous sessions and lunchtime. So let's hope we make it interesting for all of you. Thanks for showing up. This is now the third time we're hosting the Next Generation panel at IHIF. The idea behind it is really to give a platform to the young leaders in our sector to share their views, the challenges that they see in it, and their outlook of things to come with us. Before I briefly outline the topics we're hoping to cover today, it's probably worthwhile just introducing you to the panel. The overriding topic we're trying to cover today is traditional versus next generation business models that can cover everything from rising new brands to operating structures, concepts, or the new players in the market. You probably have seen from the program already, we've got a quite diverse panel today with different backgrounds, different perspectives on the sector in their current roles. So let's hand it over to them that they can briefly introduce themselves. Maybe I'll say 2 sentences about myself. I've been at Invesco Real Estate for 4 years now. I'm clearly focused on the hotel sector, hence why I'm here. We are investing into hotel real estate across Europe, have 31 hotels today. In the past, mainly leased hotels driven, but over the last 12 months, we've expanded our exposure to the sector to hotel investments subject to management contracts, and also a stake in a generator company called a hostel company called Generator, which possibly Fred can tell us a little bit more about later. Not too much about myself, because after all, we're here to listen to these guys. Maybe let's start with Guido.
Sure, thanks. Hi everyone, my name's Guido. I'm in the Hotel Finance Department of Ariel Bank. We provide debt financing to hotels on 3 continents, in Europe, North America, and Asia. We specialize on larger scale hotels in key gateway cities, prime locations. We've put out about roughly €1 billion of debt financing per year on average over the last couple of years. So we're quite active, and that's what we do in a nutshell. Myself, previously to joining Ariel, I've been there for coming up to 2 years now. I was with an investment company in London, also focused on the hospitality industry, where I did acquisitions and asset management, and originally started with CBRE in the EMEA division in London as well.
I'm Teresa. I'm with real estate and asset management with Hilton. We look after the overall real estate estate in Hilton. Is 135 hotels out of our 4,300, so it's very small. We, in the international estate, look after 90 hotels that are either owned hotels, leased hotels, or joint venture hotels. In our function, we are restructuring joint venture agreements. We're looking at our own hotels if we want to sell them or not, and renegotiate lease contracts where we see appropriate or exit. And we look also after the capital expenditure into this portfolio. I'm with real estate now for 3 years, and before I've been with Hilton's feasibility team.
Hi, good morning. My name is Jacob. I work for Pandox, an owner-operator based in Sweden. We currently own 104 hotels, which of 17 we also operate under different brands. I think we have about 22,000 rooms now, and we just launched our Pandox operations, which is also for us to operate for third-party owners. We invest in one asset, but that's hotels, because we know hotels, and also because we love hotels. That's our passion. Before Pandox, I've been here for 4 years. Before Pandox, I was working in the TV industry. So, thank you.
Hi, I'm Fred Hines. I work with a investment fund called Queensgate Investments. I've been there for about a year as head of acquisitions. We focus on asset-rich operating companies, so evidently that covers hotels, but also other assets like student accommodation, serviced offices, serviced apartments, things of that nature. Previous to that, I was at Patron Capital as a vice president in the hospitality team, covering hotels. So that includes Jupiter Hotels, a portfolio of Mercure hotels. as well as generator hostels, which is kind of a topic of conversation in and of itself in terms of the new business model that hostels address in terms of in terms of asset rich but earnings high operating models. So happy to be here.
The key topics under the overall next generation business model we're trying to discuss, briefly outlined here. We're going to touch on brands, operating structures, but as well new alternatives. Hotels used to be considered an alternative asset class for real estate investors, but now we have more and more alternatives to hotels popping up, touched upon hostels, student accommodation, and so on. And it's going to be interesting to see how that develops also in their presence at the Hotel Investment Conference here in Berlin. It's been widely discussed already, and it's going to remain a space to watch. Maybe starting with new brands, expanding global companies with their brand portfolio versus smaller independent brands. Teresa, Hilton is clearly one of the most recognized hotel brands out there. And it used to be actually quite an iconic statement. If you watch some old movies, someone arrives at an airport, grabs a taxi and says, "Take me to the Hilton." These days, you might actually end up, if you have a very sophisticated taxi driver, that he asks you, which one? The Conrad, the DoubleTree, the Hampton, right? And you're clearly not the only one who's been expanding your brand profile to touch different market segments. But the question that raises is, are brands these days, when I contact Hilton, do I get the Hilton core brand? If I get a DoubleTree, can you take the customers along that journey? Do they actually know when they're staying at the DoubleTree, it's with a Hilton? And as an investor, if I contact Hilton, what am I buying in?
Mm-hmm. I think, first of all, you're right. I mean, I think when we, especially internationally, because prior to 2007, we were two separate companies, so we had only Conrad and Hilton brand that we could develop internationally. And then obviously, when we came together again, we had all these brands that we could bring over to the international estate, which so far have been Waldorf, DoubleTree, Hilton Garden and Hampton, and then obviously most recently Courier and Canopy. And we have seen tremendous growth with these. So if we had 0 DoubleTrees in 2007, we look at 65 now of them and another 46 in the pipeline. This is obviously tremendous growth. But I think when it comes to the consumer, I think the brands have to have their own right. They need to make sense in their own right. And I think you wouldn't see that kind of growth also in terms of development if not each of these brands would have their own positioning, and if not all of them have their own consumer minds that they're tackling and therefore generating demand, because I think otherwise no one would sign up all these different deals that people are signing if they are not actually consumer driven and find the demand, which ultimately drives the return to the developer, who then are more willing to develop again more of these properties with us. So we definitely do see that each of them have their very own customer segment, and I think for us it's just good as a family of brands to be able to actually capture the consumer in a life cycle, may that be from when he's young to old, or may that be for different business purposes. He might stay at different brands, and that gives that variety. So I do think that consumers clearly understand the differences in brands, and that's shown in each respective performance of each brand. We're just doing well enough that we see the tremendous development growth that we're seeing.
And Fred, from an investor perspective, clearly at Patron you outlined that you were intimately involved in actually creating your own brand. At the same time, you also had branded hotels back then, and now in your current role, you're actually looking at a development of an intercontinental hotel, which is quite a different concept if you compare it to the hostel sector. Where do you see the benefit? When does it make sense to buy in a brand, to buy the quality stamp from a Hilton product and the distribution system comes with? When does it make more sense to actually develop it in-house?
That's a very good question in terms of building your own brand versus bringing in a brand that has already spent all of the money and all of the time in terms of developing its own product and its own segmentation among consumers. For Generator specifically, we took the view that it was worth the time and effort to develop something that had a very specific touch point with consumers, with young people that are visiting capital cities in Europe. And we took the view that effectively they would see the network effect of having one asset in London and then thinking, hey, maybe I want to go to Berlin next week. And I'll go to that same exact brand, and I know the experience I'll have. I'll have a fantastic bed upstairs, but I'll also have a great social environment downstairs. And that model was effectively replicated over 12 assets. Whereas if you're actually starting a development in London, for example, with our 450-room hotel on the Greenwich Peninsula, you don't need to start your own brand if you can take advantage of, for example, IHG in this case, of their work they've already done in terms of getting people into their network, getting people to know what the brand standards are, and bringing them on site. I think that both can coexist in the same fund. You just need to know who your consumer is. For example, with Mercure, we knew that the mid-market segment in the UK actually would benefit from having a benefits program like Mercure's card system, and we brought that on board. We rebranded the Ramada Jarvis kind of portfolio, and that was very effective because people actually wanted to come to that brand. For something like the hostel segment, there was no existing wide network that we could take advantage of, and in fact, I think, as you probably agree, there's a benefit to putting in the work initially and developing that brand so that you can kind of amortize that over the rest of the assets as you roll them out. That's the advantage of that. Yeah.
And from a funding perspective, working at a bank right now, Guido, what role does a brand play in your assessment of a financing opportunity? If it's managed, if it's franchised, how do you view that?
Well, it's very important. It's one of the crucial components that we would look at when we're presented with a deal. The things that we'd look at first, obviously, are the sponsorship, so the underlying capital and who the equity is from, the operator, the agreement it's under, and then there's the condition and the location of the asset itself. So the brand is a crucial component of that, and the concept. Whether that necessarily means that it has to be a very established brand or could it be a new one, that's then evaluated on an individual case-by-case basis. But I would also definitely say that there has to be a partnership with a brand. There's got to be a story for the concept to work, and it's all got to fit together. So yeah, it's a very important component, and we would definitely take comfort from an established operator being behind it and putting their feasibility and development expertise to the business plan. Which is, of course, not to say that we wouldn't support a newer concept if it made sense to us.
Just to pick up on that point,
sure.
I wonder kind of, at what point does the tipping point come where you're comfortable with a brand, but you're also comfortable with the kind of underlying asset itself? I mean, how do you assess that, the difference between kind of, say, a Generator rolling out versus a Hilton product being slotted into the same exact property?
Well, I mean, I would say that we would also always have to be comfortable with both. I mean, the best and most appropriate operator wouldn't work for us if the asset and the location aren't right. And the same holds true vice versa. If you've got a good asset, but it underperforms in our eyes because it's not branded and conceptualized appropriately, then that would also be an issue. So the two are very closely linked. At what point we would reach a tipping point where a new, non-established brand would make more sense than an established one? I think that would probably be quite difficult to answer on a general note. You would have to, we would look at it on an individual case-by-case basis, assess the historic trading. What for us is quite important is that assets are actually trading, because we don't normally do development funding. So if a new brand has performed well over the last couple of years and there's stability in the performance, and we trust that it'll stay that way, then that wouldn't necessarily be an issue.
And have you ever actually advised a lender against a brand without finger pointing?
A borrower?
Yes.
No, I don't. I personally haven't done that, and I don't
want to have energy.
I can't recall that anyone else would have. No, not necessarily, because it's also like our involvement comes much later in the process, right? I mean, when we're presented with a case, then in most cases, the equity will have done their underwriting and they will have made the decision on who they would like to work with, and we would be presented with a business plan that has an operator tied into it. There are cases where people have a shortlist that they come to us with, and then yes, we would have a team view or an individual view on I would prefer this over that, and I would think that that is more appropriate for the property than this. But usually, most of our partners are very, very active investors who have done this for a long, long time and who have a big portfolio of hotels. So it hardly ever happens that they are considering an established core brand, Hilton, say, and a generator for the same property, because that just doesn't work. So normally you would see similar brands that would find each other in the competitive set on that same shortlist. So it hardly ever happens that you would have a big issue with one and you'd be very happy with another, I would say. But the short answer to the question is no, I cannot recall anyone having advised anyone against a particular brand.
Jacob, Pandox is one of the most diversified hotel investors out there in terms of the different strategies you deploy, the different operating structures you would consider, and you have also, well, been one of the most fiercely independent brands operators when it comes to selection of brand, the partners you want to work with, and have no brand loyalty to any particular one, which some brands had to find out the hard way. With the launch of your new operating platform, will you actually also offer management services to third-party owners, and to what extent does that complement or compete with your own investment activity?
And by management, you mean management contracts and under our own brand? That would be an interesting pitch to our spiritual leader, Anders Nissen. And I don't know in what shape I would leave that meeting. No, I think our core knowledge when it comes to operator is operations, but also that we are very flexible in dealing with the brands. So we have knowledge of several brands. We also have knowledge about independent affiliations, independent concepts. So I think that's our core strength is, okay, an operator that can deal with different brands and different type of setups. For our independent brands, up till this point, they've been sort of case-specific developed and taken into consideration the local market, the neighborhood it's located in. So yeah, maybe to some extent we could use our existing brands if that fits the new property, but not under a management contract, but under a lease, preferably under our own ownership and operation. So management contract and new brand, no, but operation, yes. So.
In terms of new brands, Teresa, you mentioned Canopy and Curio. Hilton is clearly one of the, very well diversified companies in terms of brand portfolio, and you managed to just introduce these new brands to the market without really leaving your asset-light strategy, whereas other brands that are not part of a bigger brand family actually need to maintain much more operational control, particularly in the early stages when creating that brand in order to, well, create the concept to make it able to be rolled out. You don't have to do that. How does it work? What's the magic formula?
Well, I think for us it's obviously a bit of a different story. First of all, I don't think that actually you need ownership in order to have operational control. I would say that there are very different ways, and like mainly obviously brand standards, in order to make sure that if you grow, whether or not that's franchise or management contracts, that identify what's crucial for the brand, and then you exercise on that. And you don't need to own that in order to make that sure. I mean, there are other ways to go around it, and for us, that is most probably brand standards. So I don't think that that's our way. But I think, given to your point, also it's obviously because we do have way more expertise already in this. We come from that platform where we already have so many brands and where we have a lot of operational expertise. We know exactly how to work around brand standards and how to make sure that whatever our vision is for a specific brand, how do we have to translate that into, like the key pillars of a brand, and afterwards translate that into brand standards, and how we're going to control for these and make sure that each of the hotels is adhering to these. So I think we have that experience with that, and that's obviously something that we can greatly leverage if we launch our new brands. But to your point, you are right. I think that's for us obviously a major incentive, and I think it's also incentive that our owners are comfortable with our brands and with our engine, and therefore when we do launch a new brand, that we actually do have enough owners, just by virtue of having so much trust in Hilton, that they're gonna, that we can develop new brands with, third-party capital, and don't need to go and build the first few ones ourselves. But our owners actually do have the trust in us that we will deliver, and therefore are willing to take that risk. So I think it's more a testament of what we have done already, that therefore going forward they are willing to take that risk.
Can I pick up that point? Because I think from the perspective of the owner, having control over the property and having control over kind of the consumer touch points and how you educate the consumer about the brand itself is extremely important, because it translates to other properties that you might consider for the same exact brand. So I think on the one hand, it's great to bring in a brand, a new brand from, say, Hilton, that where you've actually put in the work to, the time and energy to develop the brand and what you consider to be the consumer kind of touch points of that brand. But on the same hand, it kind of evolves over time, doesn't it? In terms of how the consumer actually interacts with your brand. So, for example, with Generator, over time, we actually figured out that people really did want to spend time down in the bar and kind of put more energy into that type of environment and that type of brand standard, if you will, for the new properties. Whereas with kind of bringing in a brand that a Hilton or an IHG has developed over the course of a year, and they roll out and they make a big announcement about, you don't really have, as an owner, you don't really have the room to kind of control how your guests actually interact with the brand. And I would say that that's actually almost a disadvantage.
Well, I guess it depends a bit how you're developing brands. For us, like if we look at Canopy, for example, it's a majorly research-driven brand. So I hope that by the time that we open them, we wouldn't be too surprised of how actually the consumers are interacting with that, or to that extent that it doesn't touch the main pillars. And to the second point that you made, for us, it's then about having really the GM who is actually the right GM, who's having that kind of attitude, who's going to be able to see if there's anything that the guest wants and where it makes sense to change it. Yeah, they take that initiative and really bring that to the ground. So I think for us, it's like these two things. I think most probably we're a bit more front-loaded in terms of consumer research, and Canopy, obviously being that's the latest one, is like most probably the most research brand that we have launched, in terms of like really trying to make sure what it was the consumer wants, where do we going to position it, what are the different services that we're going to offer, and what is going to be valued, and where do people perceive a value at. So there was a lot of work done before that. So.
Well, and you would hope that, I mean, for everything to come together and for the whole concept to work, the two have to work together, right? It's always
Correctly.
ownership and operator. And of course, when you launch something new, I mean, my suspicion would be that there always, no matter whether you develop it in-house or if you work with someone, there will always be teething problems. And you might find out along the lines that the bar is actually much fuller and much more revenue generating than you ever thought it would be, or it could be the reverse. And then a brand, I would suspect, will have to be adjusted as you roll it out.
Which I don't even think, though, is like necessarily only for a specific brand, right? It might be even specific to a hotel, and then it's always about, to your point, I think that's where we have to be proactive of working together with our ownership and making it right that we get the right product. And I think we try a lot to get that upfront right, but to the extent that also the market is shifting. I mean, like it's real estate, it's there to stay. It was probably on a 20-year contract. Things are going to shift, and maybe now you want to have the rooftop, whereas before you didn't think about it, and all these things. And I think that's where it's important to have that dialogue between manager and owner.
And you can almost take that point away from new brands as well, right? I mean, same goes for the established brands. People are changing, consumer behavior is changing, so brands have to change. And for that to work, everyone has to work together, otherwise it just won't.
Would Hilton buy a hotel in order to prove the concept, prove a new brand?
I think we have been, as I said before, we didn't need to do that now, and it's a testament to the strengths of the brands. And to be honest, it's also very clear from our senior management that that's not how we want to grow. We want to grow capital light. We are operators. We need to convince with our brands and with our engine, and that's where we put our energy in, and that's what we want to demonstrate. So at the end of the day, we will rely on third-party capital. But I think, never say never. Maybe there's something that comes up, or we're feeling really passionate about it, that we just want to do it. But now what we have done in the last years, we haven't done that, and I don't think that's the plan going forward neither.
Would you do key money or minor equity stakes or income guarantees on the management agreement or anything along those lines? Anything that's different to the established brands to roll the new ones out?
I don't think that we would look. I mean, we have our basket of things that we look at, and that's going to be on a deal and case-by-case basis. Right. And that's location-driven, asset-driven, and all of that. But I don't think that we would go out and look at different tools than we currently look at. Okay. So that would be exactly the same.
Right. Okay.
Jacob, and would you go with a major brand company who's launching a new brand? Would you give it a shot with a new brand, or would you generally, when you get a brand on board, because clearly the operations you do yourself, would you want to see a certain track record in that concept already?
We just launched a hostel 4 days ago, and we were looking at lifestyle brands before, and if this track record does not exist, it's a high risk of buying into this if we are buying the sort of the branded advantages of loyal guests, etc. And if there's a rollout plan of 70 hotels and 5 materializes, we're stuck with a brand that's not that going well for 15 years. So if you find that's the right fit of actually developing our own brand, of a new property or a conversion, we find that, okay, if this doesn't work, we have better room to maneuver. We have different angles. We have different options of fixing that brand, etc.
I think that's a key point.
So I would go for the more well-established brands if we are to franchise, and newly formed brands, we want track record, I guess, or we run it ourselves.
If Generator was a franchise system already, would you have put it on your Copenhagen hostel?
No, we wouldn't.
That was clear.
No, well, there is.
I know, but
I
completely agree with the flexibility of having your own brand that you've developed in-house, that you can kind of pull all the levers around if things aren't working upstairs or downstairs in the public space. And I totally agree. I mean, you have to have a product that is really well understood by owners, consumers and the brand itself in order to be able to franchise. And I think, in all fairness to Jakob, I mean, Generator is still evolving over time. To your point, I mean, it didn't have that front-loaded, kind of researched, well thought out business plan in terms of accelerated growth over time. What it does benefit from is experience in each of its new markets as that happens. And so having a second property under franchise in Copenhagen, while that would be great for the brand, I mean, it might not necessarily be great for Jakob as a new owner.
But they would be competing against each other.
Absolutely.
And when we launched Urban House, we had a unique hotel in a very strong neighborhood, meatpacking / red light / young, up and coming. So we wanted this concept to reflect the area it was located in, and also have a sort of a natural fit in this area. And if we would have gone with Generator, which I think are a cool hostel brand, we would compete. And now we're competing, of course, yes, but we would compete any other way. So yeah.
Talking about sector-specific expertise, Guido, Areal is one of the best established hotel financing banks in Europe and also globally. And you mentioned before that brands play a big part in you assessing financing opportunities, but you also look at the business model and the underlying asset. And I believe you actually took quite a big risk when you funded a new concept actually in Citizen M that ended up performing extremely well. They're now one of the most talked about disruptors of the established brand society, and you went with their first property already. What convinced you of going along with that journey?
Well, it's true. We financed their first 2 properties in Europe, actually. On the risk part, at that point, it is we believed in the concept, and as I said earlier, what we do is we look at every financing opportunity on a case-by-case basis. We have our general parameters, and some have flexibility, others don't. But we try to make an individual call based on sponsorship, asset, concept, brand, and we're a team of specialized hotel people. What I think is quite particular about us that everyone in the hotel team has a hotel background and genuinely understands the business. So we feel that when we're presented with a business plan, we can make a call on and evaluate it properly. So in that particular case, we felt that it was a great concept that had promise, and history's proven us right in this case, and we went along with it. So it was a case of good sponsorship, good business plan, and also the parameters of the deal. I mean, the other point to add on that note is, whilst we of course have flexibility, you wouldn't, in a case like that, see our most aggressive terms. So. Right. I mean, as you said, there's risk embodied in there, and that would be reflected in the offer that we would make. So I think that to a degree we took a leap of faith, but also we hedged our position through the way we structured the deal. And depending on who's behind it, there are always things that you can look at. And I'm not saying that was the case here, but guarantees and so on and so forth. So there are ways to structure this.
As an investor, same as a lender, alignment of interest is always a big topic these days when it comes to actually discussing branding, operational control of the asset, and so on. You have all kinds of new structures popping up. When you look at a certain operating agreement, you don't know anymore if it's a lease contract, is it a management contract, there's guarantees, what's the nature of the cash flow. But when you discuss who to brand a certain property with or who to operate it with, what's your preferred way of achieving alignment of interest from your operator?
in general, and this applies to my experience at Patron as well as it applies to my experience at Queensgate. In general, if we're bringing in a manager who really knows, and this is for brands that are owned by your IHGs, your Hiltons, your Accors, if we're bringing in a manager that is going to be aligned with us, what we really like and what we prefer is for them to come in on the equity side and become an owner themselves alongside us, and then put in a franchise agreement with the major brand. So that'll be a third-party operator that will bring in a lot of the perspectives that we talked about in terms of the GM being on site and really having an on-the-ground understanding of how the product is evolving over time. We want that in all of our properties. So if there's a management team that can come in and align with us both from the, I would say, capital side, buying into the properties and then, having a share of the upside when an eventual sale happens, that's ideal. And then they actually are very, very, very much incentivized to have their team, their GM, their operations team, looking at every single detail on the property, and really kind of squeezing out every, additional revenue angle that they can get. I mean, if the idea is to have a really cool, Thursday night wine tasting, fantastic, have that. I don't think you necessarily get that with some of the brands that aren't aligned and some of the GMs that aren't empowered to do so. So obviously Generator notwithstanding, because that's an owned brand, but with your Accors, with Intercontinental, for example, you really want the guys that are running the property to feel like owners. And the best way to do that is kind of the equity side. So empowering them to do so is the best thing to do.
And do you feel that amongst the major brands, are most of them open to something like that? Or are you finding that a difficult
They're open to
sell?
it because they're coming in as a franchisor, as a franchise owner, right? Or as a franchise brand owner. Mm-hmm. What I want is for there to be an intermediary in between that, where they're managing, the property itself, as opposed to the major brands actually writing a management contract. Because at the end of the day, I would rather, for this property, whatever it ends up being, to be a big portion of how the manager is thinking about their economics on the back end, and not just kind of a number that's being slotted into an annual report presentation that's just talking about flags. I want to be more than a flag. I want to be a property, rooms, public space. I want to be aligned with the people that are actually running it. So that's.
So do you mean like upon sale, like a promote for the manager?
Potentially.
We're definitely more than happy to do that.
No, but I think the promote thing is kind of secondary to the initial equity slug and the way that people think about their interest in a property. When they know that they're an owner and they walk the property every day, that's absolutely key. And I think, every hotel benefits from that when their owner is very much incentivized to have the best operation every day that they can.
But is a JV? I mean, of course, I completely agree. Is a JV the only way of getting there? I mean, you could structure a management agreement with, say a promote, and Teresa would be happy to take the promote on top. But would you be prepared to sacrifice your incentive fee on the GOP and slot it all onto the bottom line? Because that would get you there, right? You'd be incentivized to drive NOI margins, which is eventually what you want. Mm-hmm.
But I think that's what you have right now, right? I think, I mean, at the end of the day, I think that's what you see, how management contracts are structured and why, of course there's the base, but then, I think the base fee you really have to see as like being part, that's like your franchise fee in a way, right? Because that's as being part of the brand, and that's what you would pay anyhow. And when it comes to the real management fee, that's really where we see that, that's where we pretty much aligned because it is based on GOP. So I think there is a pretty strong alignment. And, I think you're completely right in terms of, as an owner, it's really important, like about key personnel and GM appointment and so on. I can see how that's a major point for owners. And I think you're right. A lot of it flows with the GM, but I think that's where you look for the strong operator who has like the talent in the pool in order to get you to the right GMs to your properties.
We talked about the hostel sector already quite a bit. You mentioned also service departments, Brett, as part of what you're looking at. What about other forms of real estate with the bed in it? For example, the extended stay segment is getting increasing attention across Europe. It's been much more established already in the States. Hilton has a few extended stay brands over in the States. Are they going to come over to Europe anytime soon?
I think, no, first answer. I think what we're seeing is, are there a few extended stay opportunities in Europe? Most probably there are in some key markets that we see, but we don't see that it would be scalable to the extent that it's worth bringing the brands over. And I think the brands that we are bringing over, we want to make sure, and that, ties into the point that you made before, you want to really only bring over the brands that you can develop to a scale that they resonate with the consumers. We don't need to bring over Embassy Suites to develop 6 of them. So our point is that we don't see right now the scale of it, that might change over the times, but right now we don't see that we could actually scale our extended stay brands in Europe. But what we are doing is, when we look at it on a case-by-case basis, the question is, okay, so there's a business case for an extended stay hotel, so is there a hotel demand in general? So most probably there is. So to the extent that we are looking at, building a Hilton and then incorporating, so to say, residences in it, which do have a kitchenette and which cater to extended stay guests, then we are definitely willing to look at that. So you have the normal full-service hotel. We do have some units, so to say, extended stay in it, and that if to the extent that the extended stay demand falls away, that you can reincorporate them into the room stock. That would be something that we look at on a case-by-case basis, but we're not going to bring over our extended stay brands.
Jacob, other sectors of the hospitality world, let's call it, that Pandox finds exciting to, get involved with, get their hands dirty?
Well, we hope we will get excited by getting into hostel. It's about easy. It's been a lot of fun. But the day we opened our urban house in Copenhagen, we also took over operations in Oslo of Grand Hotel. So our scale is basically from hostel now to 5-star. So we're interested in almost everything. So yeah.
I think another asset class that didn't get mentioned is student accommodation, which, while you could look at it as resi, at the end of the day is really basically an extended stay that doesn't necessarily require a kitchen. I think it's very interesting in London. I don't know the stats offhand, but you effectively have a student market that is crying out for their own space that isn't competing with, the publicly rented residential sector. And anyone who lives in London right now and has ever put in an offer to rent a flat and been rejected outright because someone else put in an offer, 5 minutes after the application, the advertisement went out, will understand that. And students face a unique challenge in that because, they're asked to put up major guarantees. They're asked to put up a lot more rent than, someone that has a well-paying job at a private equity fund or a, hotel brand might have. So it's a unique segment of the market. It's a unique segment of the market because it's absolutely necessary. Similarly, another another business that Queensgate owns is London Executive Offices, which is a serviced office provider that's white label. I'm just drawing a parallel here because if you are a startup and you're not able to put up a 6-month or 2-year, 6-month to 2-year guarantee for your rent, for your office space, you're a bit stuck. And serviced office accommodation actually really helps you out because you can write a reasonable lease. Sure, you pay a little bit of a premium for it on a monthly basis, but you're actually able to get in situ, start your business, and move forward, as opposed to just being stuck, like a lot of students become when they move to London, either having to rent way outside of zone 1, 2, and 3, or stack up 10 people in an accommodation that should actually only be living 2. So I find that segment actually very interesting, student accommodation.
I think we tried to cover a lot of ground in just 45 minutes. I would just leave it up to you to probe the panel on any aspects that we haven't yet touched upon. Any questions?
I think I can speak up, even though the generator party last night was. Well, so I'm interested in the urban house in Copenhagen.
Yep.
Do you plan to? I agree with you. It's very fit for the location. Do you plan to expand and build this brand, or is this really meant for this exact location? Or will you find other places around Europe where you can take it and scale it?
Oh, first and foremost, we're going to see how it goes. And if we were to expand, we were to take the same approach as we did with Copenhagen, to look at the area, to really have the area reflect the hotel. Dealing with local vendors, looking into the different target segments, etc. But yes, I think we could start looking at this on other destinations in Europe too. And that I would say that we would run it under a lease or own the property and also run it. So not to the terms of franchise or management contract, but yeah, that would be the concept. Thank you.
So you don't really, like when you set out on a venture like that, there's no master plan to actually build a brand and in the end, like 10, 20 years down the road, end up with big brand value.
No.
Concept.
Well, the master plan, I guess, reached Copenhagen.
Right.
And Copenhagen was our master plan. We'll see how it goes. If we can grow it, fantastic. If we can't, we'll focus on just running Copenhagen as good as we can.
So the primary interest is asset value at this stage rather than brand value. Okay.
I would agree with that, actually. In general, if we were to launch a new brand and Generator at its early stages was like this, you kind of have to look at the asset value first and foremost and kind of what that yield reflects. Mm-hmm. And then any benefit that you get from the brand is upside. Yeah. And I think that's a reasonable approach for a real estate private equity guy to look at each deal as if the brand itself and the network effect didn't exist. Yeah. So any upside is purely upside.
Right.
I don't agree with that.
Shocking.
I mean, that's fine.
Well, unless there's any further questions, the last thing we want to do is keep you much longer from your lunch break. Thank you very much for taking the time this morning. Hope this was a good ending to what's been a busy and intense conference, and it was, it's going to stay interesting for this year to see some of the, new brands coming, new concepts developing, and new alternatives rising in their importance to our sector. So thanks for sharing your thoughts. And thank you for joining us this morning.